Dima, Christian, and Neil for inviting us here to present this paper. This is a joint work with Greg Adams and JS at the Bank of Canada. So before I begin, I just want to make it clear that any views expressed in this paper does not represent those of the Bank of Canada. And one more thing here is Greg is going to be helping me moderating the chat too. He is a senior economist at the Bank of Canada and will be applying to do a PhD program. So he's ready from day one. If you're looking for great PhD students, I will highly recommend you take a look at his package. So this paper is about zero DTE and how it affects the stock market volatility. So what is our research question? The first one that we're going to attack is what is the causal impact of zero DTE trading on index volatility? And our goal here is, well, we're trying to use the word causal lightly because our results is going to be based on a specific identification strategy. And if you believe it, we can interpret this as a causal impact. And what we find here is that when there is zero DTE trading, there is a net reduction of about 60 to 90 basis point in annualized term on the stock market index volatility, the S&P 500 index. And the difference in volatility that you observe, and our identification strategy here, we're going to exploit the exogenous variation across day of the week that this contract expires. So that's our strategy, which we'll discuss shortly. And we also show using difference in difference that once zero DTE trade on every business day, there is no longer any volatility differences in the cross section, and it all disappeared. Now that we document what is the net quantity of the impact, we're going to be looking at why is this the case? What is producing this impact? And we are showing that it's all coming from market makers hedging. They use the underlying index or the E-mini futures to hedge in the direction that is against the index price movement. And this is large enough that it creates a lower net reduction in the index volatility. And importantly, we show that the presence of the zero DTE market increases the market maker hedging needs in such a way that they have to intensify their hedging. And this is the main reason why we observe a net reduction in the volatility. We also provide some suggestive evidence using the intraday order flow in the E-mini futures to show you that, you know what, they are the order flow is moving in the same in the direction that we predict and with the same consistent economic magnitude. Finally, our third contribution and the research question here is what is the demand? How does this zero DTE market is affecting market makers? And what is the demand that driving them to hedge in this way? And we're showing that it's all coming from their hedging needs due to the end user selling up ATM straddles. When we talk about end user here, we're talking about institutional and retail investors. And they are using ATM straddles, selling put and call at the money. And this is a bet against volatility. And this is the strategy and the demand that explain why market makers have to hedge more. Now, one thing interesting about what we found is that this strategy that's driving the hedging needs is not coming from the actual zero DTE trading day. In fact, there were pre-established positions that came ahead of time using longer dated options. So these positions were established ahead of time. They just eventually become zero DTE and expire on the day, which intensify market maker hedging need. And I'm going to show you some evidence saying that the actual trading of zero DTE on its expiration day does not affect market makers hedging need. So all this is actually coming from way days ahead of the contract expiration. So why should we care with this group of audience? I don't think I need to go through this in detail. The idea here is that with the news coverage and the media attention, a lot of people believe that this is the product that could create the next Volmageddon, and it's going to blow up the volatility. And we believe that this is an important research question since zero DTE now is half of the daily trading volume of the S&P 500 index option. So main finding, okay? The main finding, we find that volatilities are lower on days with zero DTE trading. And I'll define these zero DTE in a bit. I'll go through the literature review too to see where we relate to them. Now, what we show here is the median volatility difference. And we're using 10-minute realized volatility, calculating using E-mini futures. And it's showing throughout the day from the morning, 9:30, all the way through the market close. And we do this every year from 2019 to 2021. And we are using observation within the same week to calculate this volatility difference within the same time of day. So if we're comparing 9:30 to 9:40 on Monday, we're comparing 9:30 to 9:40 on Tuesday. Same time interval. And this is what we find. Realized volatility on non-zero DTE days minus realized volatility on zero DTE days. So it shows you here that the intraday variation of volatility of the index is higher when there is no zero DTE trading. And we do not do this after 2012 or 2022 because after the mid 2022, this product trades on every business day of the week. Therefore, there's no longer cross-sectional variation for us to produce this result. And we confirm this using the cash index, and it shows almost identical results. Now, what is zero DTE option and how it has developed this market? Understanding this is quite important for showing our identification strategy. So what we refer to zero DTE here is just an SPX option, S&P 500 index option that expires at the end of its trading day. And when this, what this definition means here is that it has to be a PM settlement option. And interestingly, zero DTE has been trading since 2005. So this product is really not new. It just got a lot of attention and volume just exploded recently. Traditionally, SPX option have 8 a.m. settlement, meaning that it will settle on the morning of the third Friday of the month. So that's the traditional conventional S&P 500 index options. But in 2005, there was the first introduction of PM expiration SPX that expire on Friday and with PM settlement. So that was the first time zero DTE appears because now you can actually trade throughout the day just before the market closes. So this product got very popular that in 2006, well, you know what? CBOE also introduced other PM settlement style, but it expired at the end of quarters. And this could be 2-3 quarters ahead of time. Long maturity options, but they expire on the last business day of the quarter, PM settlement. In 2014, CBOE introduced end of the month, PM settlement style. So these end of the month would expire on the last business day of the month. And importantly, these two products here, they do not on our specific weekday. They will expire on the last business day of the month, which means that we observe cross-sectional variation that zero DTE would have expired. Now, in 2016, weekly PM expiration were introduced on Monday, Wednesday. So adding to the regular weekly Friday expiration. And in mid-2022, CBOE completed the calendar day of the week by adding the Tuesday and Thursday expiration. And this allowed us to see zero DTE expiration every single day. So an important understanding here is that now all the PM settle options, index options, now trade under the same symbol called SPXW. Even we talk even if we talk about quarterly or end of months, they all trade under the symbol SPXW, and all SPXW symbol root will become 0 DTE eventually on the expiration day. So this is the daily trading volume in 0 DTE, and it's from 2019, that's when it starts here, to the end of 2023. And we're showing the top graph Monday, Wednesday, Friday. The bottom graph is Tuesday and Thursday. This is the total number of daily contracts traded. And what we see, the first vertical red line here, that's when the Tuesday expiring SPXW contracts get introduced, and followed immediately by the Thursday expiration contract. An interesting thing here is that in this period, trading of 0 DT on Monday, Wednesday, Friday were commonly observed. That's because of the regular weekly SPXW that expire on those business days. But we also observed some trading of 0 DTE on Tuesday and Thursday also. And all this is coming from precisely the expiration of quarterly SPX, the end of the month SPX, and the holiday exceptions. So Tuesday and Thursday 0 DTE did exist during our earlier period because of these exceptions. And what I mean by holiday exceptions is because when the contract that were supposed to expire on Monday, Wednesday, and Friday, when these days happen to be a holiday, CBOE would move their expiration to a neighboring Tuesday or Thursday. And this is going to be how we identify the variations across the day of the week to help us compare the difference in volatility on day with and without 0 DTE trading. So let's review the related literature first. Our paper here is really showing the hedging impact of market makers on the underlying index volatility. And this literature has been established long ago. Neil has a paper that long ago that looking at how the hedging is impacting the underlying stock price on the day of expiration. And we are a part of this literature. Now, there's also a growing literature that looking at the pricing of 0 DTE options. More paper is coming out on this area too. So we are related to that set of literature, except there's no pricing here. All of our results in this paper are based on very simple panel and OLS regression. So let's look at exactly our contribution and how we relate to this. We are closely related to the papers that look at the impact of 0 DTE trading on the stock market volatility. So that's where we're coming in. And there are a few papers in this area. The first is Bogart, Han, and Wan, where they show that 0 DTE trading increases the stock market volatility. And their way of identification is to use the past trading volume as an instrument. And they conclude that 0 DTE trading exacerbates market volatility, and this is related to the high percentage of retail trading volume. We find the opposite result. And there's another paper here by Dim Iraker and Wilcock that show that they also use this intraday data on market makers' exposure, and they show that the exposure that market makers have would create a hedging need in 0 DTE that does not exacerbate the index volatility. And they have many other results in that paper too, besides showing that 0 DTE exposure does not exacerbate volatility. Now, this is where we come in. This is our paper. What we do different and contribute is that we quantify the net impact of 0 DTE trading and the net impact that is leading to the reduction of the volatility. We also address the economic mechanism that produces this impact. We show that this is coming precisely from market maker hedging needs due to 0 DTE position and not from non-0 DTE positions. We also explain the shift in demand that increases market makers hedging needs. And one thing we found ourselves, what's surprising here is that the shift in demand is coming from the longer dated contracts that eventually expire. And this is what driving all the hedging and the reduction in volatility. So here's our data. We use several sets of data from the intraday option trades and quotes from CBOE. So that, and also 1 minute interval SPX option and quotes that give us the Greek variable. The open close volume is going to allow us to actually calculate all the positions that's happening. What is the market holding on each contract at any time? And E-mini futures is going to allow us to calculate the order flow and realized volatility of the S&P 5 index futures. We also have many other results showing how CODT trading affects trading costs and market quality, but I think it's probably going to be in a subsequent paper. So moving on to the next topic, the first results here, let's talk about the causal impact. So here are the rest of the outline of this presentation. We're just going to attack first, second, and third research questions. The first here is...
Let me jump in with a question from Pedro Garcia. Question is, how much of this 0DT volume is coming from investors closing their options positions? Is this volatility reduction effect coming from investors demanding more of these options or due to investors closing previously open positions?
From what I remember, it's coming from both. It's coming from both. There's a lot of closing position in the out of the money, in the wings of the moneyness. So, Greg, correct me if I'm wrong, but I think it's coming from both. But they also new positions. I cannot give you exact number, but they both driving the daily trading volume on the day of expiration. Yeah. Anything else? Okay. So if not, I'm going to talk about our first estimate. This is the main regression result. This is the simplest regression. This is an OLS regression with one independent variable. A dummy if there is 0DT trading that day or not, 1 or 0. And our dependent variable here is the 10-minute volatility of the S&P 500 cash index, 10-minute realized volatility. Very simple cross-sectional regression, but we control for a large set or rich set of fixed effects. So here we're controlling for year times week times time. And we are showing that the volatility is lower on day with 0 DTE trading. And the magnitude here is quite large, 67 and 49 basis points. And because of these set of fixed effects, we are controlling for the volatility within the same week and same time of day. And same time of day is 10-minute interval time of day during the same week. Now, if we add day of week fixed effects, the results become stronger. Now, with the day of the week effects, we are now comparing volatility within the same week. And how we identify this directly comes from the occasional expirations of Tuesday and Thursday contracts that are due to quarterly end of the month holiday exceptions. So that allows us to add this set of risk effects and comparing within the same week, same day of the week. We can repeat the same results with E-mini futures. If you don't like the cash index, we have E-mini futures. And something really interesting here is that the coefficient estimate are almost identical between E-mini and cash index. And this was not a surprise to us in the end because the correlation between cash index return and E-mini 10-minute interval is like 98%. So results is very robust. And this is a very strong set of fixed effects. Now, one thing we're also going to show here is that the higher intraday volatility disappear once 0DT trading on every day of the week. And we're using the difference in regression. Why do we use this setup? Because before mid 2022, 0DT traded mostly on Monday, Wednesday, Friday. zero DTE trade on every business day. So we're going to use this.
So Che, let me jump in. So your sound quality just deteriorated a bit. I don't know what changed, but there was a discontinuous change in the audio quality.
Okay, I'm going to switch into my none. Can you hear me better?
Yes.
Okay, thank you. I'm just going to use my not use my
While I
headset.
interrupted you there,
Yeah.
from Steve Figalewski, what are the underlyings for these options? Are there E-mini futures that expire on the same day? If so, are those the contracts used in hedging the zero DTE options?
So very good question. The underlying settlement value is the S&P 500 index cash level, which is not a traded asset. So the primary instrument that market makers or investors use to hedge this product are E-mini futures. And that's why when we show all our results, we repeat everything using the cash index as well as the E-mini futures. And the results hold very much almost identical. So now going back to this diff and diff, the goal here is to show that, you know what? The difference in volatility that we documented disappeared. No more cross-sectional variation, once zero DT traded on every business day. So here in diff and dip, we have an indicator for Tuesday and Thursday, and it shows here volatility was higher on Tuesday and Thursday because before their introduction of zero DTE contract, you don't observe zero DTE trading much on Tuesday and Thursday. However, if you look in the introduction term, once these Tuesday and Thursday have zero DTE trading, this gap is reversed. So it's kind of suggesting that all these volatility difference across the day of the week is coming from the expiration of zero DTE. So moving on to the next research question that we focus on is, why is the stock market volatility lower? What is the mechanism? And the mechanism that we're going to explain here is using the market maker hedging, the role of liquidity providers. The data that we have here, the data that we have here is the intraday open-close volume at the 10-minute interval. And we see the trading directions, the opening of the order and the closing of the order by customer, broker-dealers, and different type of investors. So all these investor group trade together and are intermediated by the market makers. But importantly, because this derivatives is a zero-sum contract, any unbalance in this market has to be absorbed by the market maker. So the market maker here has to absorb whatever is left over. And the concern most of the time that you hear is when the market makers ask the net seller of these contracts. And that is when their position could exacerbate volatility. So let's look at our net gamma measure in a bit, or our measure of market maker hedging needs. So for the next few slides, I'm just going to show you a simple model to illustrate when we talk about market makers hedging needs, what are we talking about? So the first measure and the most important one is the net gamma. And the assumption here is simple. We are in the Black-Scholes world, and the market maker is a delta hedger. That's it, simple. And assume that at time t, the market maker holds this much contract, WT, in the option. So that's where her portfolio begins with. Well, if the market maker wants to hedge this position, she has to hold this amount on the underlying index. And delta here is the delta of the option. So this is straight coming out from the Black-Scholes. So now this is her portfolio at time t. And assuming that she doesn't increase or change her position on the option, at time t plus 1, she needs to rebalance because option price changes, so their delta changes. And this rebalancing, determined by this amount, can be approximate directly using this equation. You can solve this. It's quite simple. And this precisely is the gamma. That's the option gamma, the change of the delta as the underlying asset value changes. The sign of the gamma is always positive for put and call because option payoff is convex. So put and call are treated differently, but the sign on W matter. It all depends on if the market maker is a seller of this contract or the buyer. If W is positive, if W is negative, let's start with this. If W is negative, then the rebalancing DQ here would be in the same direction as the change in the underlying stock price. That means that the market maker have to buy more as the stock price increases. This would exacerbate volatility. If W, the holding is positive, then the rebalancing would be in the opposite direction of the index price movement. So now that we have this amount, what is the rebalancing amount that the market maker has to do for each contract? To apply this to all the portfolio that the market makers are dealing with, you just have to sum them up across all the contracts. It's quite simple summation. And we're going to reinterpret this value in something that has economic meaningful. We're going to call this the net gamma. And what we're doing here is, first, we're going to reverse the sign by multiplying by -1. And we multiply by 100 because each option contract represents 100 units of the underlying. And now we're going to scale this by the number of underlying index share. We can calculate the hypothetical number of shares in S&P 5 index by using the market cap value divided by the index price. And what we have here is that we are able to interpret this as the elasticity of rebalancing. What is the fraction in S&P 500 index share that has to be transacted or traded to hedge against a 1% change in the index price? So that's our net gamma measure. And when the net gamma is positive, it means that the market makers are hedging in the direction that attenuates the volatility. If the net gamma is negative, they're hedging in the direction that would exacerbate volatility. So that's the first hedging need exposure. The second one is delta, the net delta. This is hedging against new order flow. So assuming that option, the market maker now has to hold new position, represented by DW. Well, she has to hedge this new order flow or the new position with this much holding on the underlying. And this can be solved easily using just option backshow delta. That's where the option delta comes in. This is for hedging the new position. And what we also do here is that we scale this by return. This essentially is the return. Try to express this in something that have economic meaningful. The sign inside of this is very important in this bracket, matters a lot because the delta of an option is always positive. A call option is always positive. The delta of a put option is always negative. So it all depends on when the market maker is buying the option. If the market is buying a call option when the return is going up, then she would have to hedge in the direction against volatility. And we're going to reinterpret this delta hedging measure as the net delta in a very similar way that we did with the net gamma. And the idea here is that when the net delta measure is also positive, it is good. It's attenuating volatility. When the net delta is negative, it is exacerbating volatility. So to show you the measure a little bit, these are monthly averages across time. And we do it by 0 DTE versus non-zero DTE for you to see the magnitude. The left hand is net delta. You can see that it's pretty much 0. Not much movement here and you can see that this is economic magnitude. The net gamma, on the other hand, the net gamma from a non-zero DTE is quite large. It's actually larger than from 0 DTE. And the economic magnitude here, let's just say that this is about 0.1%. Right. So that's 1%. That's 1%. It means that the market makers have to rebalance 1% of the underlying index shares in order to hedge against a 1% change in the index movement. So this is quite a substantial hedging need. Let's look at how these hedging needs exposure are related
May I interrupt?
Yeah.
If we go back to the previous slide, is this the piece of evidence that you say is suggestive that the hedging needs are coming from existing positions rather than from opening positions?
No, not yet.
Okay, good.
Yeah. So, okay, so let's now we're gonna look at how this hedging exposure translates into future volatility. So now we're looking at a volatility next period. We're using absolute return and realized volatility to show you this result. So first, the net gamma from zero DTE contracts, we find very strong negative coefficient estimate. This is the panel regression, simple panel regression at the 10-minute interval. We find that higher hedging needs for pre-existing zero DTE positions dampens volatility. Higher hedging needs for new order flow has small and weak, is not as robust effect on volatility. So that's delta at zero DTE. Now, we have also this result, which are net gamma from non-zero DTE, longer contracts, and net gamma and net delta from non-zero DTE. And we surprisingly find that they have no relationship with future intraday volatility. This was also very confusing at first because previous studies have documented significant impact of debt hedging on the daily volatility. But one thing that we show here is that all you have to do is remove the date fixed effects. If you remove the date fixed effects, you recover the results that has been documented in prior literature. And in fact, the magnitude of net delta from zero DTE versus non-zero DTE are very similar to each other. What this suggests here is that if you're looking at the daily level of hedging, market makers are hedging zero DTE and non-zero DTE in the same manner, which that affects the volatility at the daily level, but not at the intraday level. Now, in this figure, we show that higher market maker hedging needs lower volatility. But that doesn't point us to show whether is it really coming from zero DTE introduction. What we show here is that let's regress how the net gamma in different position changes on zero DTE trading day. The idea is to really show and point out that it is coming from an increase in the net gamma exposure from 0 day to expiration contract. So this is a simple regression that leverage that exogenous variations that we introduced earlier. And we found that hedging needs in zero DTE position increase by about 0.29%. 0.29%. The total net gamma is about 1%. So this is a third increase. So that's a significant increase. On the other hand, the net gamma from non-zero DTE went down. It went negative. And in the net, the hedging need due to the net gamma position increases, but this is coming directly from the zero DTE position, not non-zero DTE position. So our conclusion here is the net reduction is still market makers hedging need in their zero DTE position, not non-zero DTE. We also have results from order flow. So this is where we're looking at E-mini future order flow at the 10-minute interval. So why we're doing this is to try to provide some suggestive evidence that the order flow in the E-mini futures, which is the primary hedging instrument for S&P 500 index, is moving in our predicted direction. So we're going to leverage the fact that, hey, our net gamma here provide us with this nice definition, how much of the S&P 500 index share has to be rebalanced against a 1% change in index price. So that's essentially index return. So we are going to be interacting net gamma with return. We're going to sort net gamma into quartiles to create dummies because we would like to make this net gamma become positive magnitude and focusing only on the return sign. We interact these now dummies with S&P 5 index return, and that's the first result we see right here. This is the baseline result. This coefficient shows the net order flow of E-mini futures in the next period when the return in the current period moves up by 1%. And this is in the first quartile net gamma, meaning that the lowest market maker hedging need. It shows that the market maker has to trade in the opposite direction of index return, negative sign. And as their hedging needs increase, their hedging needs in 0DT position increases, the hedging, the order flow movement in E-mini future moves even more strongly against index return, providing us with some suggestive evidence that this could come from the hedging mechanism. And importantly, the magnitude of this order flow. So we interpret this order flow also as percentage of buy minus sell in E-mini futures as the total number of S&P 5 index share. We want the economic magnitude to be consistent. And we find that this gives us about 20 to 61 basis points, which is very consistent with our measure of net gamma. Again, this does not give us the direct evidence because we do not know who is originating the E-mini futures trade. It could come from many other market participants, but we believe that this provides us with some corroborating evidence. So the last part here is, how does the 0DT market affect the role of market makers? So we're getting there to your question, Christian. This is coming from pre-existing positions. So first, I want to convince you that if you want to study 0DTE, we just have to look at the customer. So these are the trading volume by different counterparties, and everyone else is kind of small. So really, we're just going to focus on the trading volume of customers who are either institutional or retails. And this is the daily cumulative volume in 0DTE by customers. I'm going to go through this plot a little slowly because there's a lot to unpack here, and there's a lot of information. So we try to show you how does the volume develop on the day of expiration. The red line represents call, the blue represents put, and this is by moneyness on the x-axis using end of the day moneyness to do this plot. At the money is in the middle there, out of the money call, in the money put to the right, and etc. The darker the line, the later in the day. So it shows you the development throughout the day for put and call and from different moneyness levels. So moneyness is defined by K over S, strike over the underlying. So this is the net position in 0DTE by customers. So this is when they expire. Again, red is call, blue is put, and by time of day. The darker, the later in the day. First, I want to focus in the wings. These are the wings. What's happening here is that customers are expiring by holding a long strangle position. They're buying out the money call and out the money put. But if you look at the middle, they are also shorting volatility using at the money straddle. And if you combine these two strategies together, it is what we call iron butterfly, another closely related one called iron condor. And the most important thing is that it's really from the contract in the middle here that generate the hedging demands of market maker, because the gamma of an option contract at the wings, out the money, they are essentially zero. But the gamma of an option contract at the money is increases exponentially as the time to expiration decreases. And this, if you were to calculate the net gamma position of customers throughout the day, this is what it looks like. You can see that all this is gone. From the wings, from out the money, go to zero because their gamma are zero. And it's all coming from the at the money short volatility bet that creating this. So that's what the gamma that customers produce, which is absorbed by market makers who are the counterparty. And we show this results below here of the market maker. That's why they have positive net gamma, which is driving an increase in their hedging needs in the direction that attenuates the market volatility. I want to recognize also that, yes, we are using, this is K over S based on end of the money grouping. We show that the result hold regardless of if we were to sort based on high volatility, low volatility. So this sorting is to help us allow to accumulate position throughout the day, but it works and the results robust too, whether there's a lot movement in index price or not. So now let's get back to the question that Christian asked, is that how do you know it's coming all from pre-existing longer dated options? So this is going back to customer net open interest. Net open interest, what they are holding on the day of expiration. And we're going to zoom in exactly right there at the money shorting volatility, right? You see that net open interest in ATM doesn't change much, right? Doesn't really change much on the day of expiration. So this gives us some kind of indication that they must have entered into the day with already a short volatility bet prior to the day off. And we have this results to prove it. So this is almost our second last one here. So what we do here is that we're going to separate market makers net gamma into two components. One coming from the new position and one coming from stale position. Our net gamma can be easily decomposed based on which position you're using. The stale, that's what we call it. It's coming from net position as of 9:30 a.m. on expiration day. So we calculate net gamma using the 9:30 a.m. net open interest. Hold that position constant and just let the gamma of the option contract evolve. And you can we see here the band is a 75% quartile. The new position are from new option trades that only occur after 9:30 a.m. So we're looking at new position that just accumulate on the day of expiration. And one thing interesting we see here is that the net gamma coming from the contracts that are actually trading on the day off have almost zero impact on the market maker's net gamma. So I hope this kind of convinced you a little bit, Christian, that it's really coming from position from yesterday ahead of time. We also have some more results in the paper that showing potentially causal impact, that it's really the increase in net gamma already originated days ahead of the expiration. Okay, so I think I'm going to finish ahead of time, which is great. So in conclusion, the first thing here is that all else equal, we find that the S&P 5 index volatility is lower on days with 0 DTE trading. And I hope we convince you with our very simple regression and identification and strategy that this is true. Volmageddon is very unlikely, but this is based on how this market is currently trading. I want to be that clear. It's based on how it's been trading, which produces market makers positive net gamma, making them hedge in a way that lead to a reduction in volatility. Now, our result here can be explained by the increased hedging needs coming directly from 0 DTE position and not non-zero DTE position. And we want to highlight that this is important, right? We're not just showing that market maker net gamma is positive. We show that it actually increased due to the presence of the 0 DTE, which further intensify the hedging needs, explaining the reduction in volatility. finally, the third conclusion that we have here is that all this demand that created the market maker hedging needs are coming from contracts, longer dated SWPX contracts that eventually becomes 0DTE. And on the day that becomes 0DTE, market makers just actively hedge them in the direction that attenuates volatility. And one key takeaway here that we find very interesting here is that there's a lot of research on 0DTE market now. A lot of people are going to this, and I think it's important because it's half of what S&P 500 index options is now. But to part with this is that we believe that in order to understand the impact of the 0DTE market, future research, including us and many, we probably need to understand how these contracts traded ahead of time, not just on the day of expiration alone. So I believe that concludes our presentation, and I will address any questions that anyone have.
Okay, so now we'd like to invite anyone who has a question to unmute yourself and use your microphone to ask a question. But while we're waiting for you to think of your questions, I'll ask the question from Alessio Soretto. The question is, hi, Che, super interesting paper. I was wondering if you guys have dug more into the last result. Specifically, is it possible to trace the stale gamma through time? Is it coming from trades that were initiated a day ago, 3 days ago, a week ago, etc.?
Definitely yes. And because the way we calculate net gamma allow for that decomposition. And Greg and I, Greg already produced that result. It's in the paper. Not just showing the plot, we also have some regression to show this potentially causal impact using our identification strategy that this net gamma is coming ahead of the day of expiration, and market makers has been intermediating ahead of time. And we can go back further than just 1 day too. So Alessio, very good question. That's the direction we are going to.
So any other questions?
Precisely, we don't exactly how far it originated. And
now's your time to ask your questions. Now's your time to tell Che that he's completely wrong. Whatever you want to say.
Che, Steve Figluski here.
Hi, Steve.
The way you described towards the end how you imagined these positions developing, it sounded like you figured that customers would be trading straddles and strangles. And I wonder if you're able to tell exactly what they did to put on a position. And certainly a possibility, seems to me, is that they might be trading spreads with a directional idea. That is, I'm going to buy the out of the money call, and I'm going to sell the at the money call, or similar the other way around. That's sort of a volatility play, but it's not entirely. It's a big directional play. And by putting together all of the customers, you got people with long positions and short positions and so forth. So I'm interested in how those positions get put on and also how they get taken off, because I could certainly imagine somebody who's got a zero day option simply rolling it forward to the next day or the next week or whatever, buying today and selling further out. And that trade also has, if I'm a market maker and I'm making markets in more than 0 day options, that's going to affect my position too, trading the out of the more distant options. So I wonder how much you know about these ideas.
I will try to answer that. So you're right that we do not observe each individual type of trader who are customers. We only observe customer as an aggregate. And you're very right, Stephen, that there's doing volatility spread, and that's exactly what we do on the last day. They're using because they're using the out the money call and out the money put, but what we find here is those are not the one that driving market makers hedging need because their gamma are so small here. Mm-hmm. But you are right that yes, they could be making directional bet using contracts in certain direction, perhaps more order flow on the out the money call, But these positions do not significantly impact the gamma and the market maker hedging needs. So that's what we find, but I don't know whether that answer your question.
So I'm sort of thinking if
let
you
me
put it
jump
on
in because
as a spread to
go ahead,
begin with,
Steve. So let me
and
jump in
then
because
time goes along, the out of the money one one of them becomes way out of the money and sort of disappears from your position. You end up with kind of a net position in the middle.
Yeah. And one thing we also observe here is that if you're looking at the net, we're going to go quickly, net delta. So the net delta here shows you essentially how balanced to the exposure in the call and the put. So the net delta represents order flow, and this is really showing you that call and put order flow of these contracts that are about to expire are quite balanced, meaning that more call is matched by more put, rather than a one-directional bet. And this, of course, is an aggregate average result.
So, Steve, I have some relevant information. So, Suli and David Musto and I have sort of a descriptive paper documenting activity in the complex book. And this is about single names. But straddle strangles and condors and iron condors are quite rare. The dominant complex trade is a vertical spread. So I look at Chay's results here and I say, well, some people are selling vertical spreads, call vertical spreads, and some people are selling put vertical spreads. Once you combine them, it looks like straddles and strangles, but I think the actual trades that are being executed are predominantly vertical spreads. There were some other questions. I shouldn't dominate too much. There were some other, well, I think Greg may have been answering some of the other questions in the chat. So Greg answered the other questions in the chat, so I won't read them out. So does anyone else have a question that they'd like to shout out?
Just a quick one. So given that it's all from old position, the effect is how much do we trust the open close data in terms of like if you add up the positions from the open close data over days, there are some mistakes there, they accumulate. So is there a way to kind of robustly establish this effect, controlling for some of the noise in the open close data?
Dima, you have asked a very important and interesting question. I think we have this discussion before too, privately. How much can we trust? That's a very good question. I think for the index, because we have open close data that goes back all the way to 2020, 2012, we can make sure that we accumulate position for sure since the inception of the contract. But how do we trust that? How do we trust that the open close volume is true? And especially, in my opinion, as long as a buy and a sell direction is precisely identified, it will not affect our main result, which is the net gamma. But if the close buy and opening buy differ, that could have some consequence. But if you're looking at the net open interest, the net position, I think the data is reliable. Yeah.
I think if I could just jump in there, the other thing to note is based off my understanding of these weekly options, you're accumulating volume for these net open interests for only maybe 2 to 3 weeks for most of them based off when they're listed and begin trading. So you're not necessarily dealing with something where you're accumulating volume over a very, very long period of time. So maybe that's a little bit reassuring here.
Okay, so it seems that everybody has asked their questions. So it's a good time to thank you very much, Chay, for this very interesting presentation. Thank you, Greg, for handling most of the chat questions. You've made our life easy. So that was very interesting, as will be our next presentation in 2 weeks. Jefferson Duarte is going to come and scare you if you ever computed a Sharpe ratio on option returns and thought it was too good to be true. It probably was. So be there in 2 weeks to hear about it. Otherwise, thank you very much for joining us, and see you some other time. Ciao.
Thank you.